Welcome to Part 1 Guide to Understanding the Stock Market and its complex financial terms. We'll break these down for you in a simple, easy-to-understand manner. Picture the stock market as a bustling marketplace, but instead of fruits and veggies, it's the shares of publicly traded companies that are up for grabs. These shares, also known as stocks, represent ownership in the company and are bought and sold on platforms called stock exchanges. As we navigate through this intriguing landscape, we'll uncover key terms and concepts, from understanding what a stock is, to the role of stock exchanges, how stock prices are determined, and so much more. Our aim is to make this journey as engaging and informative as possible. So whether you're a budding investor or just curious, there's something for you. Stay tuned as we delve deeper into the fascinating world of stocks and shares. First, let's understand what a stock is. Imagine walking into your favorite coffee shop, ordering your go-to brew, and instead of just leaving with a cup of coffee, you walk out as a part owner. Sounds intriguing, right? That's essentially what buying a stock means. You're purchasing a tiny slice of a company, making you a shareholder. Now, there are two main types of stocks: common and preferred. If you hold common stock, you have the right to vote at shareholder meetings, and you may receive dividends, which are a portion of the company's profits. Preferred stockholders, on the other hand, don't usually have voting rights, but they have a higher claim on assets and earnings. This means they get dividends before common shareholders and have a better chance of getting their money back if the company goes under. Remember, when you buy a stock, you become a part owner of that company. Now, where do people buy and sell these stocks? The answer is on a stock exchange. Think of a stock exchange much like a farmer's market, but instead of fresh produce, you're buying and selling ownership in companies. Major stock exchanges like the New York Stock Exchange or NASDAQ serve as hubs where buyers and sellers come together to trade stocks. These exchanges provide a centralized location where stock transactions can be conducted in a controlled, secure, and transparent manner. They act as intermediaries, ensuring that trading is fair and orderly. And just like our farmers market, they operate during certain hours, typically from 9:30 in the morning until 4 in the afternoon, Eastern Standard Time. Companies list their stocks on these exchanges, and investors, through their brokers, can buy or sell these stocks. The prices fluctuate based on supply and demand, which we'll discuss in more detail in the next scene. So, the stock exchange is essentially a marketplace for stocks. You might wonder how the price of a stock is determined. Let's find out. The price of a stock isn't set by any individual or the company itself, but by the market. It's a classic example of supply and demand at work. If more people want to buy a stock, demand, than sell its supply, then the price moves up. Conversely, if more people wanted to sell a stock than buy it, there would be greater supply than demand, and the price would fall. But what influences this demand or supply? Several factors are at play here, such as the company's earnings reports, economic indicators, or even global political events. Investors interpret these factors and make decisions to buy or sell. Each transaction that occurs based on these decisions contributes to the day-to-day price movement of stocks. So the stock price is a reflection of what investors think the company is worth. To track the overall performance of the market, we use something called market indices. Picture a busy highway with hundreds of cars, each representing a different stock. Now, imagine trying to gauge the overall speed or direction of traffic. That would be quite a task, wouldn't it? This is where market indices come in handy. They are like the traffic helicopters, providing a bird's-eye view of the market's performance. Indices such as the S&P 500 or the Dow Jones Industrial Average function as benchmarks. The S&P 500, for instance, includes 500 of the largest U.S. companies, providing a broad snapshot of the U.S. equities market. On the other hand, the Dow Jones Industrial Average includes 30 large, publicly owned companies based in the United States. These indices help investors understand the overall direction of the market, acting like the market's barometer. It's important to note, though, that indices are not investment opportunities themselves, but tools for understanding investment performance. Market indices give us a broad idea of how the market or a segment of the market is performing. Ever heard of a bull market or a bear market? Let's understand what they mean. Picture a bull with its horns thrusting upward. That's a bull market for you, where optimism and confidence drive stock prices higher over an extended period. Investors are bullish when they believe prices will rise, and they buy in anticipation of future profits. Now imagine a bear swiping downward with its powerful paw. That symbolizes a bear market, where pessimism reigns and falling prices are the order of the day. Investors become bearish when they anticipate a downturn in the market, often selling their holdings to avoid future losses. These terms are not indicators of the actual animalistic behavior of investors, but they're a metaphorical way to describe market trends. They're essential to understand because they can influence your investment strategy and decision-making process. Remember, a bull market is characterized by rising prices while a bear market is marked by falling prices. Investors use different strategies when investing in the stock market. These strategies vary based on an individual's financial goals, risk tolerance, and investment timeline. For instance, a buy and hold strategy involves purchasing stocks with the intention of holding onto them for a long time, often years or even decades. This strategy is based on the belief that in the long run, the stock market will provide a good rate of return despite periods of volatility or decline. Alternatively, day trading is a more hands-on approach. Day traders aim to profit from short-term price fluctuations within a single trading day. They rely heavily on technical analysis and quick decision-making. Value investing, on the other hand, involves buying stocks that appear to be undervalued by the market. Value investors believe that these stocks will eventually be recognized by the market, leading to potential profits. These strategies can help investors make informed decisions about when and what to buy or sell. In investing, there's always a relationship between risk and return. It's like a seesaw on a playground. On one side, you have risk, the chance that an investment may not perform as expected, or even worse, lose value. On the other side, you have return, the money you stand to make from your investment. Now picture this seesaw. If risk goes up, the potential for return also goes up. This means that investments with higher potential for returns usually come with higher risks. Think of it like a high-stakes poker game. The greater the risk you take, the larger the potential payoff. But don't be fooled into thinking that risk is always bad. It's about striking a balance based on your personal risk tolerance and financial goals. Remember, without taking on some level of risk, your money may not grow fast enough to reach your goals. In a nutshell, understanding the relationship between risk and return is crucial in making wise investment decisions. Higher potential returns usually come with higher risks. Dividends are an important aspect of investing in stocks. But what exactly are dividends? In simple terms, they're a portion of a company's profits that are distributed to shareholders. Think of it as your share of the company's earnings, a reward for your investment. Now, not all companies pay dividends. Some prefer to reinvest their profits back into the business for growth. However, companies that do pay dividends are often seen as financially stable, making them attractive to investors who prefer consistent returns. But how do dividends affect stock prices? Well, when a company announces a dividend, it can make the stock more desirable, potentially pushing up the price. Moreover, consistent dividend payments can signal a company's ongoing profitability to investors. And here's the cherry on top. Dividends can provide a steady income stream in addition to potential capital gains from rising stock prices. So, dividends can be a win-win, serving as a safety net in volatile markets while also contributing to your overall investment returns. We've covered a lot of ground in understanding the stock market. From deciphering what a stock really is, to the role of stock exchanges and how stock prices are determined, we've journeyed through the intricate world of market indices and the tug-of-war between bull and bear markets. We delved into various investment strategies, explored the crucial relationship between risk and return, and touched upon the significance of dividends. Each of these elements plays a part in the grand opera of the stock market, a performance that never truly ends. It's a complex tapestry woven with threads of economics, human behavior, and global events. But don't let its complexity deter you. Every expert was once a beginner. Remember, Understanding the stock market is a journey, not a destination. Keep learning, stay curious, and let your investment journey be one of constant growth and discovery. See you in part 2 of this guide to stock market.